Wealth management is not just for the wealthy. Everyone is entitled to their best retirement possible. Welcome to The Retirement Engineer with Jim Kruzan, your path to a bigger, bolder retirement. Brought to you by Kaydan Wealth Management, a firm that specializes in serving the mobility technology industry. In this podcast, we help you maximize your resources and engineer your best retirement through a process-driven approach so you can get the little things right. Drawing from years of expertise, Jim and his guests will simplify complex wealth management strategies and explore actionable ideas to help you protect your hard-earned wealth and take control of your future. Now, on to the show.
Today, we delve into a topic that can hold the keys to a successful retirement. This episode is an eye-opener as we explore the top 5 Social Security filing mistakes that can potentially disrupt your retirement strategy. From navigating spousal benefits to avoiding the pitfalls of early filing, we're here to guide your every step of the way. Now, keep that notebook ready because by the time we're done, you will have the insights you need to secure your Social Security benefits and optimize your retirement plans. I'm Patrice Sikora with your host, Jim Kruzan. So, Jim, let's get started. This is a complicated topic, but give us a base understanding of Social Security and how it works with retirement plans, because let's face it, Social Security benefits were never meant to be your only source of income in retirement.
That's absolutely true. In fact, today, I guess on average, maybe Social Security accounts for a third of the equation. In fact, the intent was for it to be a supplement to other methods of retirement. So think of that as one leg of a 3-legged stool, where Social Security accounts for one, personal savings and investment accounts for the other, and then the very last would be pension. Obviously, a lot has happened over the last 88 years since the signing of the Social Security Administration Act. That was actually 88 years ago this week.
Oh, wow.
And at that time, the vast majority of workers, especially those that worked for private companies in urban areas, were covered by pensions as well. Today, it's a little bit different. There's only about 15% of employees as of last year that work in the private sector that are covered by what would be deemed traditional pensions. That said, there are still 86% of those who work for state and local governments that have something that kind of looks like a traditional pension. So when we look at this third of the equation, that number differs quite a bit. It can be significantly more than a third of the equation, representing much more than a third of one's income for those who generally have lower income and earnings power to begin with. And for others, it might be quite a bit less than a third when we consider the other resources that might be available: pensions, personal investment, savings, etc. So Social Security started, as I said before, back in 1935. The very first workers began participating in Social Security shortly thereafter by making payments. And it was about 3 years later, toward the end of 1939, when this 65-year-old woman decided to retire. And she happened to see the Social Security Administration and decided to walk in. And her name was Ida Mae Fuller. And Ida Mae, at age 65, signs up for Social Security. Now, Ida Mae had only been participating for several years. So January 31st, 1940, the Social Security Administration issued their very first check number 00-000-001 to Ida Mae Fuller. And her monthly benefit at that point in time was a whopping $22.54. Now, the interesting thing, and by the way, Ida Mae was a single teacher, and she worked her whole life as a teacher. So she received her benefits starting at age 65. And by the way, that was the age upon which you would receive benefits. And Ida Mae lived to be 100 years old.
Oh, she got the
And
most out of the system,
oh my God.
didn't she?
Over her lifetime, Ida Mae received a sum total from Social Security of $22,888.92. But the real kicker is the total amount of money that Ida Mae paid into the system was $24.75.
Good investment, woman. Good investment on your part.
Right. And from that point forward, everybody else had somewhat less of an investment experience than Ida Mae. But it's really interesting how the system has kind of morphed. Back then, it was essentially a retirement benefit for the elderly. Today, Social Security encompasses a much larger component of cash flow and spend, and as a result, a much larger component of government spending as well. Today, it provides retirement benefits, which was its original intent. It provides disability benefits. It provides survivor benefits. And it also provides supplemental benefits, or often called spousal benefits. So as a result, when we look at where things are today, there are, I think, 30 some million individuals that are receiving monthly retirement checks from Social Security Administration at this point in time. However, there are something closer to 70 million individuals that are receiving some sort of benefit one way or another, whether that's survivor, disability, supplemental as well. So we can understand some of the inherent problems with Social Security and Social Security funding and those kinds of things.
Well, why don't you explain how it is funded? I mean, from your paycheck.
Right. So Social Security should be considered a participatory retirement plan where both the employee as well as the employer participate. And they participate by paying a premium, which is removed as a tax of a total of, well, it's 6.2% of earned wages, which comes out of your paycheck. It's part of your payroll tax. And that is also supplemented by an employer tax, which is to the same degree. So the total amount of tax is 12,000, or I'm sorry, is 12.4%, 6.2% for both parts. And it is calculated, the benefit, based on your highest 35 years of earnings. So and that starts at age 21. So the comparison started at age 21, and it's the next 35 years of earnings. They calculate something called an average indexed monthly earnings number, or AIME, which is essentially the sum total of your earnings history divided by 420, which is essentially 35 years, 12 months a year. And that number then becomes what's referred to as your primary insurance amount. And that primary insurance amount equates to a monthly benefit. So the bigger your average indexed monthly income is, essentially, the bigger the benefit becomes. 35 years is the period of time that they look at. And they look at, as I said, the highest 35 years. If your work career is something less than 35 years, then for every year you're missing, it's populated by a zero. So if you haven't worked a full 35 years, the benefit is somewhat compromised. If your earnings period relative to the maximum amount of earnings they consider as a calculation for the average indexed monthly income, if that is also compromised, then effectively the benefit is compromised as well. The idea is, if we're getting closer to retirement, and if we have the ability to delay retirement and the next several years of employment, might be able to replace some of the lower years and in effect skew up the 35-year average, which also then skews up the benefit. So that's essentially how that works. Today, one pays into Social Security up to a certain earning level. That level is changes every year. It's indexed, and currently it's $160,200. So, should one make $160,201 or more, they stop paying into Social Security.
Right.
So that's how the system is actually calculated.
All right. So that's how the system is calculated. That's your earnings history. What determines, when should you take it? That's the big question everybody asks. What age? What is my retirement age? When should I say, okay, yeah, I'm here. Let me get my benefits?
Right. So presently, the folks out there that are receiving Social Security currently or are about to receive Social Security, their full retirement age, that is when the Social Security benefit that you would receive essentially kind of maxes out as it was intended, is anywhere from age 65 to as much as 67. What determines that is the age of one's birth. Mm-hmm. So anybody who was born before 1943, they would currently be 81 years old and certainly receiving Social Security. They would have received it at full retirement age. That's referred to as FRA, full retirement age, at age 65. Anybody who was born after that, right up through and including 1954, would have received Social Security at full retirement age at age 66. And for those that were born after and including 1955, for every year thereafter, the full retirement age increases by 2 months. So, for example, if you were born in 1955, your targeted full retirement age is age 66 in 2 months. If you were born in 56, it would be 66 in 4 months, and so on and so forth. If you're born after age or on or after 1960, it's 67 years of age. And all that means is your benefit is not discounted. If you elected to take your benefit before that date, before that age, let's say at age 62 or older, there would be significant discounting for someone who could receive their benefit at age 66. If they decided to take their benefit at 62, that's a 25% haircut. That's for those who, right? And for those who would be expected to take their benefit at age 67, if they took their benefit at 62, that's a 30% haircut. And that's substantial.
Now, 62 is the earliest, aside from special conditions, 62 is the earliest you can take Social Security, correct?
That's correct.
But you have that haircut, as you say.
You do. And actually, if you can stick it out to full retirement age, and there's a number of good reasons to do that. And if you have the ability to, in fact, delay the benefit even further, the benefit increases significantly beyond the full retirement age. And it increases right up until age 70. So in our practice, as we're talking to clients, depending on cash flow needs, and more importantly, depending on resources, we really try to build a strategy around delaying Social Security as far out as possible. The difference between taking it at 70 versus taking it at 62 is at least a 76% increase.
That's incredible.
It is, and it can be more depending on inflation. In fact, since the last several years, we've had a much, much higher degree of inflation than we have, let's say, the last several decades. The ability for somebody to delay their benefit was quite significant. Between the 8% a year bump in benefit that one gets by delaying beyond full retirement age, they also enjoy whatever the cost of living adjustment would have been as well. So with the very high inflationary periods we've seen, especially last year or 2020 going into 21 and 21 going into 22, where the Social Security inflation adjustment was in some cases 6, 7, 8%. And then you add to that a contractual bump of 8, a year-over-year change in benefit for the rest of your life by securing a one-year deferral, just simply waiting a year, can be as much as 14%. That's huge. And it's also very hard to replicate. It's almost impossible to kind of reverse engineer that and say, okay, well, what rate of return would we have to earn on this to be able to increase our benefit for the rest of our life and then increase the base upon which Social Security inflation indexing applies? It would be nearly impossible. And if one could do that, they would have to subject their portfolio to a significant amount of risk with no certainty that they could do that.
In your opinion, is there any situation where it is appropriate to file before full retirement age, say at 62, 63?
There is. While we prefer to have our clients delay as much as possible. And oh, by the way, with respect to that, 15 years ago, a good 60% of individuals would file at age 62. That number has been reduced. That number has been cut in half. But still today, on average, only about 6% or so of Social Security filers actually wait until age 70.
I'm shocked at that.
So a lot are beginning to wait till full retirement age, but really those that wait beyond, and the difference in benefit is significant by waiting beyond full retirement age. So what would be the reason one would want to take the benefit early? While it certainly makes more sense to delay, if one were to take the benefit early, it would make sense really as it would relate to two things. One would be if there really are no other resources available, there's nothing else that we can call upon to create cash flow to help bridge the difference in years until one were to collect Social Security. That would certainly be something to consider, and we could see where that would make some degree of sense. In another area or category, I would have to say health comes into play.
True.
If there's a significant health concern that where there would be a high probability of shortened mortality, then that certainly comes into play because that then skews the break-even point in terms of do I take it or defer benefit. And then I suppose there would be a third. And that would be in situations where an individual is attempting to delay and they're using resources to kind of plug that cash flow hole. Mm-hmm. But because of market conditions and such, the portfolio is now under duress. We're spending on a percentage of the portfolio significantly more than what we should be comfortable with. One of the easiest ways to de-risk the situation is turn the spigot on, start receiving Social Security. So even though it was compromised, it may be better than continuing to erode the portfolio because we come to a point in time where it's almost a point of no return, where the portfolio values have fallen so much that it's going to be nearly impossible to kind of rebuild off those levels, kind of a terminal value. At that point, the easiest thing to do is turn the switch, create cash flow, and then immediately de-risk the situation.
All right. Talk to me about the earnings test and why this is something you should not ignore.
Yeah, unfortunately, some folks do ignore this, and it does require some careful planning. Obviously, there are some individuals who retire, decide to take Social Security. They take it before their full retirement age. And then they find that they decided to either go back to work or work on a part-time basis, which is perfectly fine. However, the benefit will get compromised And in fact, the benefit will get reduced based on the amount of earnings one has once they've opened their file and are starting to collect Social Security. So it's careful to kind of understand exactly what your earning power is, what you're expecting to do. As an example, right now, if one has earnings over, I believe it's $21,240, that's after they're receiving Social Security, then for every $2 of earnings, they lose $1 of Social Security benefit.
That seems pretty egregious.
So from a cash flow perspective, it's problematic because you now no longer have as much money coming in as you thought. If you are turning full retirement age, the year you turn full retirement age, starting January 1st, for every month before you actually turn full retirement age, they've changed the limit. And that limit now is $56,520. So you can earn up to that without having your Social Security impacted. But if you earn more than that, then for every $3 in earnings, you lose $1 of benefit. So let's talk about what that actually means. So it affects the immediacy of cash flow because you're working and you're getting a bit less than you would have because it's digging into the Social Security benefit. But in the big scheme of things, it may not be a problem because those years where your Social Security was modified because you have now earnings, that year of earnings may very well replace a year amongst the 35 that are being averaged.
Okay.
And it may actually skew up the average. So then when you stop working, the Social Security benefit is reset to reflect a better 35-year average, a better PIA, et cetera. The other thing to consider is if the idea was you were planning on retiring, you decided to take Social Security, and then an opportunity came up for what would be deemed full employment. You decide to work another year, or you decide to consult for a year or so. If you can make that decision within the first year of filing and receiving Social Security, there is the opportunity to do a do-over.
But you only can do this once, don't you?
You can only do it once, and you can only do it within the first 12 months.
Right.
And what you do is say, oops, I made a horrible mistake, Social Security. Here, let me give you back the benefits I've received. And we'll do this as if I've never filed in the first place.
Right.
It used to be up until just several years ago that you could do that indefinitely. So 5 years in the Social Security, you realize you would have had a much bigger benefit had you just waited, and you could give all that money back. So basically it was a tax-free loan that the government was giving you for that period of time. You pay it back and then you reset your benefit. Social Security got wise to that, and now they will only allow it within that first 12 months. But it is a strategy that would certainly make some sense. And at the end of the day, it would drive a bigger benefit if we were to just do a do-over and then reset with another year or two of higher earnings, which may skew that 35-year average as well.
When you're talking about the earnings test, what income is considered? Is it investment income or just earned income?
It's just wages. So earnings from the portfolio, which is considered passive income, doesn't impact those numbers. It will impact the taxation of Social Security, which we'll get into in a little bit, but it doesn't impact whether your Social Security benefit is going to be reduced as a result of your earnings that year.
All right. You mentioned earlier spousal benefits. Talk to me about those.
Yeah. It wasn't that many years ago that we would talk to clients about retiring, especially in cases where they would have a non-working spouse, a homeowner, a stay-at-home mom, let's say, and they didn't realize that there were additional benefits that one can claim from Social Security beyond the primary worker's benefit, and that's a spousal benefit. And the spousal benefit is, again, this is for a non-working spouse. A spousal benefit can be up to 50% of the full retirement age benefit of the primary worker. That said, as with any Social Security filing strategy, it has everything to do with age. As an example, if we have a working spouse who is now retired and drawing Social Security, a non-working spouse can claim a spousal benefit as early as age 62. However, if they take the benefit at 62, as opposed to waiting until their full retirement age, that benefit is compromised. That benefit is less than it would be otherwise. And that's a permanent compromise. It diminishes not only what the non-working spouse would receive, but it also diminishes what the family would receive in the aggregate. So it's really, really important to plan cash flow around when we need money and how best to access the filing status with Social Security. It becomes even a little bit more complicated where you might very well have a spouse who is not the primary worker in the family, but did enjoy some employment, did pay in the Social Security, and may very well have their own benefit. Mm-hmm. We have to look at what that benefit looks like in conjunction to what the spousal benefit would be off the primary.
Right.
Spouse is not allowed both. They're allowed one or the other, and generally it's expected they take the larger of the two. So the question then becomes, do we take a benefit early and then take the spousal benefit, or do we take the spousal benefit early and then wait to take one's own primary benefit? Very complicated. In fact, if you consider all the different iterations of Social Security, when to take what and how, and consider other things like divorce, which we'll go into, there are something in the order of, I think, 9,409 different filing iterations. So it's important to kind of take a step back, figure out what we're trying to do, what resources we have, and how best to proceed going forward.
And like you said, divorce and remarriage, what does that do to it?
This is an area where I think a lot of folks kind of miss opportunities. And that is to say that if you were married to a primary worker, then divorced that primary worker, you haven't remarried, you have the ability to claim a spousal benefit off of that primary worker's status in spite of the fact that you're no longer married to that primary worker. And it can happen to as many ex-spouses as an individual might have. So the divorced ex-spouse can receive a spousal benefit. And if there was another divorced ex-spouse who also hadn't remarried, they can receive essentially the very same benefit as well. It's not like the benefit gets divided amongst two ex-spouses. So you can see why we've got 70 million people participating in some capacity of Social Security, while there's just 30 million or so actually receiving what I would
half
call
were married to the same person.
Could be. Well, Donald Trump potentially can have three spouses or ex-spouses doing that as well. So it's important to kind of consider when the claim. You can claim a spousal benefit as long as you've been married to the primary worker for a period of a year or more. So it doesn't take a lot. And if somebody's a serial marrier, I suppose that they can turn out a lot of ex-spouses over a period of time. So it's kind of interesting. And those rules are a little bit different than let's say, survivor rules. Should a spouse pass, what happens to the survivor?
What happens there?
Yeah. So first off, the period of time is a bit different. To claim a survivor benefit, you've got to be married for 10 years as opposed to a 1 year period. The biggest difference is you can claim as early as age 60. And I often don't recommend that. It really has a lot to do with who has the bigger benefit. As a general rule, you want to wait to take benefit until full retirement age. And as a general rule, you want to defer as far as possible the biggest benefit that would be coming into a household. So depending on whose benefit is bigger and cash flow, there's a whole decision tree around when best to take. As an example, I've got a client right now whose husband passed. His benefit is clearly much larger. His widow, she is not yet 62. She could claim her own benefit, but she can't claim that till 62. Or she could claim her husband's benefit through a survivor situation now because she's over age 60. But if she claims over age 60, that benefit is severely reduced. It's discounted because she is not full retirement age. So the best strategy there may very well be to wait until she is 62, have her claim her benefit, which is the smaller of the two. And then when she would turn full retirement age, she can then claim unrestricted, without discounting, her husband's survivor benefit. So there's a number of different strategies that are involved with survivor benefits based on the age of the surviving spouse, whose benefit was bigger to begin with, and the period of time that we have to bridge the gap.
With all these cases, something comes to mind. Let's just argue that people are claiming it at 62. Do you have to actually do the paperwork a certain amount of time before or after 62 to get it? I mean, it's like 6 months before to have it kick in. 62 or
yeah, it's usually not. It's usually they prefer 90 days or
90 days. Okay.
or more before.
Okay.
If you did it anything less than that, you'd still get the benefit, but there might be a bit of a delay.
Okay. Just curious.
Before you receive the first check.
Well, how about the taxes on these benefits?
Yeah. The government never makes things as easy as they possibly could. So there are a couple of things to consider in terms of taxation with respect to Social Security. And what it has to do with really is how much of the Social Security is included as and considered part of your taxable income. And there are certain ratios and thresholds if you're filing single or if you're filing as a married couple. Just considering the married couple situation, if your provisional income, and I'll define that in a minute, because again, that's something you'll not see anywhere else. If your provisional income is less than $32,000 a year, then none of your Social Security is included as taxable income. It's essentially tax-free. If your provisional income is $44,000 or less, so between 32 and 44, then 50% of your Social Security benefit is then included as taxable income and subject to whatever your effective and marginal rates would be. And if your provisional income exceeds 44,000, then 85% of your Social Security benefit is included as ordinary taxable income. Now, that seems like a really, really high number, but when you consider if you go to work, 100% of your wage is ordinary taxable income. If you take a distribution from an IRA or a 401k, 100% of that distribution is considered ordinary taxable income. And if you receive a Social Security check, worst case, 85%. So there's a little bit of a tax savings there. But the thing that trips a lot of people up is this provisional income situation. And the calculation is strange. I think I understand why they do it this way. But what they do is they start and they look at your AGI. Now, AGI is your income before any reductions, standard deductions, etc. So you take your AGI, you then reduce it by deductions, charitable contributions, all that, and then you get to taxable income. So what they do is they look at the bigger number, the AGI number, and then they add back to that any tax-exempt income you might have. So this increases the AGI even further. So you can't claim poverty if you're sitting there with a $1 million muni bond portfolio throwing off 4% a year. You got $40,000 of tax-free income. They're saying, no, we're going to include that in this calculation. And then on top of that, the third component is they take 1/2 of what your Social Security benefit would be. So AGI plus tax-exempt income plus half of Social Security. If that number is below 32,000, no taxation. If it's 32 to 44, half the Social Security is included as taxable income. And if it's north of 44,000, then 85% of it is included. So obviously, depending on household and cash flow, we've got to be somewhat cognizant of kind of where we are on this. How does Social Security shake out? And are there certain things that we might be able to do from a planning perspective or an asset placement perspective to kind of keep us under that threshold? Examples of that would be, if somebody had an IRA and they weren't necessarily taking distributions at this point, so they were planning on waiting till 73 or later before the required minimum distributions kicked in, and they owned bonds or they owned other income producing assets, it might make sense to own those as it would relate to the portfolio, maybe inside the IRA, because that would then be all deferred income. It wouldn't show up on your tax return and it wouldn't increase your AGI. There are other things that can be done. If somebody is a consultant, has a little bit of a side business, there might be an opportunity to reduce business-related income. Are we expensing things as opposed to capitalizing things? Are there ways to drive that business income and maybe show a loss that would help reduce AGI? Are we charitable and are we taking full, are we helping to drive certain charitable deductions? If we have an RMD, can we do a QCD or a qualified charitable deduction, which helps to reduce modified adjusted gross income? So there are certain things that can be done. And are we also taking and maximizing as much as possible any capital losses? Are we harvesting those? Because those can be used as well to offset gains. So that's important as a function of regulating this provisional income calculation, which then drives taxation. Again, it's not as easy as what's the income, here's the tax. There's a lot more calculating being done.
And this just brings us back to, you kind of touched on this earlier, but what if you make a mistake? What if you sit down and you say, I don't think I did the right thing. Jim, can you help me?
Well, there's the ability to do the do-over, but it's more important if you realize, hey, you know what, I'm probably not being as effective or as efficient as I could be. There's a lot of things that could be done, both in terms of orchestrating and allocating resources. If we haven't started taking Social Security, but you had an idea of when you might like to take it, to kind of walk through that and better educate and better understand what the consequences are of taking something early. The one thing we didn't touch on is primary worker waiting till full retirement age. If one of the most important things for that primary worker is to protect as much as they possibly can their spouse should something happen to them financially. It's really important for that primary worker to wait until at least their full retirement age. Because if they open their file and claim their Social Security benefit early and they pass, their spouse will then roll up onto their benefit, but that benefit is now compromised. That benefit is less than it would be otherwise. So kind of sorting a lot of those things out is really important. I think the other thing that a financial advisor can really help with is there is some really slick software out there that will allow us to input our Social Security records of our clients, both the primary worker as well as the spouse. And as I mentioned, there are 9,400 and some iterations of filing, and the software will allow us to run those and see what makes the most sense in terms of maximizing benefit relative to the resources that our clients have. And I think that's a big difference between running by and discussing strategy with an advisor who's got a 30,000-foot view of all the resources and how they all interplay versus just simply going to the Social Security Administration, because often their bias is what do we need to do to start the payment as soon as possible, which doesn't consider other resources, time frames, or interest. And I think at that point, the deliverable, the experience probably is significantly better. We've had many cases where clients were turning full retirement age, and they were planning on going into the Social Security Administration and discussing things. And they came out sold on the idea that they should start their benefit now because they're at full retirement age. Whereas our recommendation would have been, let's use resources, delay the benefit till age 70. And they didn't believe that you could do that because of what they thought they heard from Social Security.
Right.
And then finally, when they kind of follow our advice, and then finally, when they get to 70, they can't believe how much more money they have coming in the door by simply delaying those benefits. So you get a little bit different view, a much more strategic view, having those discussions with a financial advisor than you would simply at the Social Security Administration.
Have you ever had a client that got the wrong information from Social Security?
We have, more so when they're calling on the helpline than face-to-face, and more so before the rules changed. There was a major change in Social Security rules, egads, I want to say maybe 7 years ago now. And there were some other filing opportunities that were available prior to that, where the spouse, as an example, the primary worker could file and then defer taking their benefit. And then once their file was open, the spouse, the non-working spouse, could enjoy a spousal benefit. All the while, the primary worker would delay their benefit and take it later. Well, we understood those rules and we understood the strategy. But when they would go to Social Security just didn't understand that. Like, well, if you're filing, then you're taking your benefit. No. We don't want to take our benefit. Right. Well, you can't do that. Well, yes, in fact, you can do that. Today, it's much less confusing because there's no longer that strategy available. But those clients who did that under our guidance, which was different than the original recommendation from Social Security, certainly are much happier as a result of that.
I would think so.
Yeah, I mean, if a couple does things correctly, you can easily see 70, 80, as much as 100,000 a year from Social Security benefits, depending on how much your primary insurance amount would have been in the first place. Yeah, it's amazing.
Well, Jim, as we wrap up, that is so much information. That is a great amount of wonderful information. It is really a a labyrinth out there, though, in Social Security. I think you really do, you would benefit by having someone help you through the process.
I would agree.
All right. So when it comes to Social Security filing, our choices do have a profound effect on our retirement journey. According to these top 5 Social Security filing mistakes, well, if you avoid them, you empower yourself for what lies ahead. Whether it's early filing intricacies, enhancing spousal benefits, or maneuvering through survivor benefits, you now have the understanding to make some well-formed decisions. Also, most importantly, perhaps, if you still have questions, seek personalized professional guidance. And be sure to subscribe to the Retirement Engineer podcast so you don't miss future episodes. And of course, follow at Kaydan Wealth on social. Let us know what you think in the comments. Please share topics you'd like us to discuss in future episodes too. Following and sharing this podcast helps our small show make a larger impact. Thanks for being with us.
Thank you for listening to The Retirement Engineer with Jim Kruzan. Click the follow button to be notified when new episodes become available. Visit our website at www.kaydanwealth.com or give us a call at 800-638-6900. The information covered and posted represents the views and opinions of Jim Kruzan and this episode's guests, not necessarily those of Kaydan Wealth Management. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.